Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V. Robb, how was your week?
Week was great. Was actually out of town a little bit in Northern California, some wine country. That was awesome. I'm back in LA area now and ready to go with this week's five things. We've got a a great episode coming up. Gary, any opening remarks just about the episode or thoughts before we kind of highlight and outline what we're going through?
Well, I think we owe everyone an apology. Last week we were high energy and happy. This week, unfortunately, we had to call it the stagflation and doom issue. I guess, Robb, it's 2024. That means we have to give people trigger warnings. The economic news this week is upsetting. For people who can't handle upsetting economic news, you should turn it off now. In fact, everyone just turn off your video now. No one watch this.
And I don't know if well, it is actually a very ominous sign, but in Southern California right now, I can hear thunder and there was lightning as I was coming to the office as well. So I think it is just the perfect environment for the stagflation and doom issue that we're talking about this week. But Gary, we got a lot of exciting stuff, a little surprise here coming up in a quick minute. We're going to be talking about retail sales. We have CPI, PPI data, gold and Bitcoin again. But what I'm really most excited to talk about coming up right out of the gate is we have a special guest on our show today. And Gary, I'll let you take it from here.
Terrific. Well, everyone, I'd love to introduce you to Lax Ganapathy from Unicus Research. She is a short specialist. Not that she's short, but she's great at shorting stocks. And the reason we have her on this week is because one of the companies that she recommended shorting a few weeks ago is heading for zero. Shorting a stock to bankruptcy is one of those ultra difficult scalps that every short seller wants to claim. And so, bad news for this company, but Lax, congratulations on the phenomenal call.
Thank you so much, Gary. Thank you, Robb. Yeah, it's shorting any stocks to zero is very challenging.
It is. Yeah. So we're talking about Fisker, ticker FSR. Lax, when did you first recommend shorting it and what did you see that caused concern?
Well, back in 2020, when SPACs are a big deal, all the company like Fisker, Faraday Future, all became public. So it's around 2021, if my memory serves right, we recommended Fisker. This is Henrik Fisker's second rodeo in trying to manage an EV company. His first one filed for bankruptcy. Now this is a second one on its way to bankruptcy.
Got it. So I'm looking right now. Stock price in 2021 was around the $15, $20 range.
Yes.
And then where is it? That's barely above zero right now, right?
Yes, it's right now about 15 cents.
Well, so that's an incredible return. What went wrong at Fisker, and what did you see a couple years ago that enabled you to say, wait a minute, this thing is a disaster. It's a zero.
Gary, the challenging thing is just not limited to Fisker. It's about the entire EV sector, right? So EV sector has electric vehicle companies have a huge problem. They have scalability issues, they have reliability issues, and they have cash issues, right? So Fisker has scalability and reliability issues. And we started to see a pattern in all of the EV companies, specifically for Fisker. Henrik Fisker has a track record with EV. That's a story for another day. Fisker has a reliability issues. Its core, it has a software issues. There is a lawsuit going on where the car stops in the middle of the road, almost causing a life of its clients. So that's a huge issue.
Okay. And Lex, I know one of the things you've written about before, because I'm on your email list. I read your weekly piece every week, but you wrote something, I want to say it's 2 months ago, about the danger of buying an electric vehicle where the manufacturer is going to go out of business because without software updates, you own a very expensive piece of furniture.
That is true. And that no one addresses that issue because everybody thinks, okay, we have a car, we have an EV car, we are saving an environment. No, you're not saving an environment. That is number one. Number two, when the company goes bankrupt, no one has a clue. So the company, if it goes bankrupt, it has to make a deal with another company or make sure its software is open source so its consumers can continue using it. So that's the issue.
Got it. All right. Last question for you, Lex. One of the things that you've talked about and written about at length, and I know you've been early on this topic, you've been talking about it for years. There is the perception you just talked about that EVs are great for the environment. If you get rid of your internal combustion engine car and buy an EV, you're going to save the world. I know you're not a fan of that thinking, and it's a complicated topic, but just give us the outline of what some of your environmental concerns are. Speaking just to the people who want a better environment, why do you think EVs are not a good solution?
Because EVs manufacturing process is not kosher. So those are not environmentally friendly. EV cars, the battery is not environmentally friendly. And I will get back to you on the statistics, but for an EV to be environmentally friendly, it has to take a certain amount of mileage and years for an EV to be considered environmentally friendly. So in a nutshell, EVs are expensive. They are not reliable. There are liability and safety issues for the consumers. They are, in a nutshell, EV is a sustainability dynamics is an expensive and emotional trap for investors, manufacturers, the environment, and the consumers. It's like trying to sell a product because if you don't buy it, you're harming the environment. So it's like a guilt-driven manufacturing marketing gimmick.
I love the way you describe it as an emotional trap, especially given the fact that they advertise these vehicles as zero emission vehicles, but the batteries require hundreds of pounds of lithium. Hey, Lex, any idea what fuel they use to mine lithium?
Not electric.
It's diesel. It's enormous amounts of diesel fuel.
The problem with that mentality is after the fact, the lithium batteries are going to waste. There are only two companies, as far as I know, I am not researching currently on that. There are only two companies in the world that are recycling the lithium batteries. So they have to dismantle them and take all the minerals from it to reuse them. And it's a very complicated and an expensive process. No one has figured that out.
All right. Terrific.
Gary,
Well,
if you don't mind, before we let Lax go, actually,
Sure.
I have one follow-up question that I know my my circle will be interested in. If any, right? What does this do for obviously the big dog in the space, Tesla? Does it mean anything? Is it absolutely not corollary in any way? But just curious if there is anything that we can take from what happened with Fisker. Is it something completely mismanagement? Just curious on that side.
With respect to Tesla, we consider that as a cult stock. So we haven't recommended it as a long or a short. To be completely candid, after researching the entire EV sector for 3-4 years, I have no clue how Elon is making this scalable and where the money is coming from. That is a separate discussion because he is burning cash and he is like trying to recycle one thing into another thing. No clue, but I'm pleasantly surprised it's still a going concern.
Thanks,
all right.
Lex.
Well, Lex, thanks so much for getting both of us kicked off of Twitter, or X as it's called now.
Yeah, we're going to be in trouble.
I appreciate that. Thank you so much. So for people who are interested in an alternative view of alternative vehicles, Lax Ganapathy from Unicus Research. Lax, we'll put a link to your Twitter or X account in the description here, so
Thank
people
you.
who are looking for you can find you and sign up. I would suggest people sign up for Lax's weekly newsletter. Like I said, I read it every weekend.
Thank
Definitely.
you. And thank you
Thanks,
so
Lax.
much, Gary. Thanks, Rob, for having me.
All right.
Of
See you
course.
soon, Lax.
Anytime.
See you soon. Bye.
So long.
So long.
All right.
Great stuff, Gary. Yeah. And I know we're going to do, I think, talking conscious effort, right? Get another guest on the show. So Lax coming in from Unicus Research. If you read the 5 things, you'll see some information about the company and more about Lax's great work. Don't hesitate to reach out to her. And as Gary mentioned, both of us are subscribers to the platform on a weekly newsletter basis. All right, Gary, should we jump into our regular feature of the 5 things?
Yeah, let's go.
All righty. Thing number 1, Gary, we're talking CPI. The CPI comes in hot.
Yeah, so the story for all of last year was disinflation, and that was very misleading because people got the idea, oh, good, inflation's going away, we'll have lower prices. Well, Rob, that's not what happens, right? Disinflation, for everybody who, remembers your high school calculus, is a change in the rate of change. Yeah, I know I've just lost 3/4 of our audience here. It's a second derivative calculation, but the easiest way to explain it is we still have inflation. It's just less than last year. So prices are still going up, but at a slower rate. And the hope that people had was that we would have continued disinflation to the point where they'd get to this, magical 2% number. That's the target. That number, by the way, it's what the Federal Reserve is aiming for. I will just point out the correct and moral rate of inflation is 0%, and the Federal Reserve's mandate is stable prices. There's nowhere where it says 2%. Rob, one of the things we talked about last week is how much 2% inflation can steal for you. Basically, over a 40-year working life, 2% inflation steals more than 50% of the value of your money. Don't think that this is not a big deal. It is. And so what we saw was the February CPI. That's the Consumer Price Index. That number is manipulated, but it's generally regarded as the inflation number, the measure of inflation. And it came in at 3.2% versus last year and 0.4% versus last month. Both of those numbers are 0.1% above last month and 0.1% above the expectation of 3.1%. The core number was up 3.8% for the year and 0.4% for last month. Here's why all of this matters. The core number is almost double the 2% target. And if you start to annualize 0.4% monthly increases, you end up with something close to 5% for the year. That's a problem. The Fed does not have inflation under control in the way that people had expected and hoped.
Yeah, my 2% and 3% inflation stat is one of my favorites to use at the dinner table, but I think I need to be careful because I might stop getting invited to some of my dinner parties coming with the doom and gloom. But hey, I'm just trying to bring them the news. And Gary, I know takeaway here, right? When we talk about the Fed and movements, right? You're going to tell us higher for longer, right? Is there anything else like that can be done from the Fed's side? Because for me, it seems like we're just going around and around and around and around with really not much progress being made in any which direction, it seems. And if anything, things just continuously getting worse.
Yeah, so let's take that apart. First of all, the CPI is understated, and it's designed to be understated, right? People in government don't want us to know how much of our money they're stealing. And by the way, that is theft by government. When the value of your savings, when the purchasing power of the dollars that you hold in your bank account or anywhere goes down, you wonder, well, wait a minute, where did that value go? The answer is it goes to the people who are printing the money, who are spending the money. That's Congress, right? That's the government. So that's the big issue there. The other thing is inflation always works this way. You have it goes up and down in cycles in various places. Services inflation has been a problem. And the reason that's been an issue is because the Fed doesn't have a lot of control over that. It's very hard to for the Fed to just raise interest rates and magically affect all of this. But the market is starting to take note of this. And just as a reminder, we came rolling into this year with the expectation that the market expected, not us, the market expected a total of 6 rate cuts starting in either January or March. And that 6 rate cuts adds up to 1.5%. Deep knowledge investing, we've been screaming, no, not a chance, no way, not going to happen. Powell's serious on higher for longer. These hot inflation prints force his hand. And at this point, the market has now cut the expectation for rate cuts for this year from 6 or 1.5% to 3 cuts. So that's now 0.75%. They've cut the expectation for rate cuts in half. And at this point, the expectation had moved from the first rate cut coming in January that then got pushed back to March. Then people were saying, okay, June, we'll get that rate cut in June. Well, as of today, the market's saying 50-50 on this. And so what we have, and we've talked about this on this show before, we have this quiet war between Congress and the Treasury on one hand and the Federal Reserve on the other. So Powell's trying to raise rates or higher for longer, keep rates higher to try to get inflation under control. Well, Congress is spending and the Treasury is monetizing this. So we just have more dollars flooding the system. That's going to lead to more inflation. There's not a whole lot Powell can do unless he wants to start raising rates again. And I don't think he does. We're going to know more in the next couple of days. The Fed is having their 2-day meeting this week. We'll get more information. But, I would be shocked if Powell came out and said, yeah, you're getting rate cuts in June. He could say it, but I'd be surprised.
Interesting. And we'll make sure to keep you in tune with all of those happenings. Be sure to subscribe to the newsletter online, free version as well, to at least alert you with things that are happening in the market. Point number 2, Gary, we're talking PPI, producer price index. The PPI also comes in hot.
Yeah. So we've got multiple, actually, these are 4 different inflation indexes, right? The consumer price index, the CPI, the core CPI, and then for the PPI, the producer price index, you have the regular and core. This all came in high. It was a bad week for people hoping for rate cuts. The reason the PPI matters is because producer prices work their way into higher consumer prices. So Rob, let's say you and I run a manufacturing company. When our expenses go up, the PPI will rise. We'll say, hey, as we're manufacturing, we have higher expenses. Well, what happens 3 to 6 months down the road? We pass those price increases, our cost increases onto consumers. That makes its way into the CPI. So I
thought you were going to say executive wage cuts are the first thing that go.
No, it's not. Maybe it should be, but no, that's it's a nice thing to wish for, but it's the doom and stagflation and doom issue.
Sorry, not to cut you off.
Yeah, not the lollipop issue. So basically the PPI is sort of an early look at the CPI. And when the PPI runs hot, people say, oh no, in a quarter or two, we're going to start seeing higher consumer prices. So let's get to the numbers. The February producer price index came in at 1.6% versus last year. That's actually pretty good, right? That's not a bad number. Even I, who like stable prices, okay, 1.6%, that's not so bad. So why is this the doom issue? It's because the monthly increase was 0.6%. That was double the expected 0.3% rise. Again, does a 0.6% increase sound like a lot? Like, if something costs $100 and then a month later it costs $100.60, is that a big deal? Well, it doesn't seem like much, but if you start to annualize that 0.6% increase, that annualizes to 7.4%, and wow, that is a massive problem for the Federal Reserve. The other thing is, for people who are, looking at this, I encourage you, go to the comments, click the link and take a look at the written version of the 5 things. We have the PPI and core PPI graph there. They flattened out, right? The disinflation story there is really dead. And what we're starting to see is a monthly increase. This, again, is going to be a problem for Powell and the people who are begging for the pivot to lower rates.
We talk about, that stuff trickling downhill, right? Like, how much higher can we go with the consumers, bearing the burdens of these cost increases? Does that lead to companies closing their doors? What does that trickle down effect start to look like?
Yeah, so I don't know that we're at the point where people start closing businesses. That we're not seeing a lot of that yet. The employment picture is, we talked about this last week. It's good, but it's manipulated. And the reason I say that is because unemployment is low, employment is high. There are almost 9 million, there are actually 9 million jobs available. These are good numbers, but the new jobs being added are all in government and healthcare, which is funded by government largely. So, we've got a situation where the government is basically creating their own employment report. So I don't know that that's necessarily the issue, but for people who are fans of economic history, if you go back and take a look at what happened in the late 60s and through the 70s, Fed chairman at the time, Arthur Burns, thought he had inflation under control, let off the higher rates. He was not a higher for longer guy, and inflation came roaring back. And so you see these almost cycles going up and down when we look back through the 70s. And are we at that point now? No, it hasn't gotten that bad yet. But you start to project a couple more months of 0.6% month over month increases, and yeah, we're going to be looking at inflation numbers, with a 3 or 4 or 5 handle later in the year. Now, do I think that's going to happen? It's hard to say. But basically what I'm saying is we're not at the panic point yet, but this was not a good month for the Fed, and a few more months like this, and we will be looking at a resurgence of inflation and basically, where inflation had bottomed and starts to rise again. I'm not sounding that alarm yet, but a couple more months of data like this, and that's where we're going to be. And it'll basically be a repeat of what we saw in the 1970s.
Great. As we mentioned at the beginning of the 5 things, so this week's version sponsored by Unicus Research. So we just wanted to say hi and thank you to them. Unicus is a short biased independent investment research firm. They perform in-depth research on ideas, speaking with tour industry sources, which have given our clients an investment edge on their recommendation. Their ideas have generated more than 70% ROI on the downside for their clients. So check them out. In the written 5 things, we'll have a link out to their track record. Again, Lax was on earlier, her information in order to contact her directly. So thank you to them for sponsoring this week's version.
Yeah,
moving to point.
Rob, I would just add that it is hard to make that call a couple of years in advance and short a stock down to 0.
Crazy.
That is, like I have done it before. It is not easy to do. You only get so many of those in a career. Like, round of applause for Lax and her team at Unicus. That was a phenomenal call, and it just happened to come to fruition last week. Like you said, the stock is down under 20 cents right now.
Yeah, and they're also offering for DKI subscribers 50% discount for your first 2 years. So if you're interested in that, please let Gary or I know as well. Moving to point number 3, thing 3, retail sales up, but below expectations. Manufacturing is down.
Yeah, so little weird economic data here. Rob, we've been talking. So last year, we were talking a lot about what looked like a weakening economy, weak manufacturing numbers, but really strong retail numbers. And we were talking about this in the fourth quarter last year. And then that turned, and retail sales have been negative in 3 of the past 4 months. That's been remarkable given the high inflation we've had. Remember, inflation, while it makes things less affordable for all of us, it does mean that when we buy things, the price is higher. And so it looks like higher retail sales. These numbers are not inflation adjusted. And so inflation, strangely as it sounds, helps retail sales. It doesn't make anyone more money in terms of buying power, but it does help sales. So this month, we had a 0.6% sales increase versus last month, which again, we've talked about that annualizing to something over 7%. And that was well above the prior month's drop, but it was also below expectations. People, believe it or not, were expecting, I think, a 0.8% increase. Now, the manufacturing data has shifted. Last month, we got a pretty decent number for the Empire State Manufacturing Survey, where it had made a phenomenal recovery off of this abysmal low. I think it was negative 40 something. I can check the numbers here.
Yeah, you're right.
But last month, the Empire State Manufacturing Survey fell 19 points to negative 21. So it went from -2 to negative 21. Understood, if people aren't following this data, that's really all you need to know. Going from -2 to negative 21 is pretty bad. That's a horrible, horrible slowdown.
Gary, in the takeaway, you mentioned stagflation again, right? We talked about stagflation, I believe it was early last year as well. Any similarities in terms of what we're seeing now versus what we've seen in the past?
Yeah, so stagflation refers to negative economic growth combined with inflation. So our first two things here, we talked about higher CPI, higher PPI, accelerating monthly numbers. Well, inflation is a problem, and it looks like we may be seeing a resurgence of that. The manufacturing numbers are telling you that we have a problem with the economy. Now, do I think we're going to get an official recession this year? No. And we've talked about this before. We talked about this last week. It's an election year. Congress is going to spend like crazy. And this is your weekly reminder that government spending adds to GDP, gross domestic product, regardless of whether it creates value or not. So the example that we always give is the government could go pay 10 million people to dig ditches and pay another 10 million people to fill in those ditches. And congratulations, we've just employed 20 million people, and all of that spending, even though it's created no value, gets added to GDP. So the reason we're talking about stagflation is we definitely have a resurgence of inflation, and the manufacturing numbers have been weak for a while. They've been really bad. And so all of that indicates that we potentially have a problem in the real economy. I don't think we're going to get the official recession only because of government spending. And that is basically the equivalent of taking a bunch of high school kids and telling them to grade their own test papers. My guess is everyone's going to get an A. Congress is trying to give themselves an A here.
Gotcha. Thing number 4, we mentioned it at the beginning of the call, but just to circle back, Lax from Unicus Research, Fisker, ticker FSR, heading for 0. What about the EV sector? So be sure to check that out, or check out our little cut-ups with Lax and what she had to say there. Great call again from Unicus in 2020, I believe it was, she said, when they first made that. Yeah, 2021, when they first made that initial call. Moving to thing 5 of this week's version of the 5 things. Gold and Bitcoin around all-time highs. I know we talked about this a little bit ago. I saw some questions online. I'm sure that's where this thing is coming from. What does that mean, Gary?
Yeah, so that is where it's coming from. And I got some criticism last week from someone on Twitter or X, and I thought they made a good point. Last week we were talking about gold and Bitcoin. They were at all-time highs. Bitcoin has had a horrible retracement. It's gone from, 73,000 to 67,000, which, 3 weeks ago, every Bitcoin holder would have been thrilled to be at 67,000, right? These mini pullbacks, at this point just make me laugh. And we put up a segment from the show saying, hey, Bitcoin and gold at all-time highs. And, what does it mean? And somebody pointed out, hey, you didn't really tell us what it means. You didn't really give us the analysis. You just pointed out that it happened. And you know what? Mea culpa. I think that was fair criticism. It was reasonable. We pointed it out, but we didn't really explain to people what it meant. And so, we're taking the criticism to heart and coming back, and let's give people, I think, a good explanation of what we think is happening and why these two things are happening at the same time.
Gary, with the court, for me, it was right, almost like you see them in a way kind of inverse, right? But at the same time, they're both moving the different direction. For you, is it a preference between Bitcoin, gold? Is it, I know within the DKI portfolio, it's, hey, we have both, right? Can you dive even more into detail of why this is happening or what you think is causing this?
Yeah, so let's take those in order. First of all, I own both. Because we have so much money printing and so much overspending, I'm concerned about the purchasing power of the dollar going forward. One of the things that we talk about a lot, right? I don't know the price of Bitcoin a year from now or 5 years from now, but I do know the purchasing power of whatever dollars you have in your bank account are going to be down. So I like owning both. Now, if people want to know my preference, I have an enormous position in Bitcoin because it's gone up so much. It is the largest position I own. It is outsized in my portfolio. Gold, I have a decent sized position, but of the two, I prefer Bitcoin. But let's talk about the meaning of these on an individual basis, right? Let's take gold first. gold is considered one of the best risk off assets. So risk off means, hey, when money's coming out of the market, when you're worried about the stock market, when you're worried about your local fiat currency, just a fancy way of saying whatever government currency. So the dollar is a fiat currency, the yen is, the euro, the British pound, right? The Peruvian sol. These are all fiat currencies, a government currency. When people are worried about their fiat currency, when they're worried about geopolitics, we have multiple wars going on and Taiwan's being threatened. We have shipping lanes that are being closed. These are the kinds of things that maybe will say, oh no, there's a ton of risk. Gold has been, a reliable money alternative or unit of money for thousands of years. And so people turn to gold during those times. And I don't think it's a coincidence that at a time when we have massive geopolitical uncertainty, when every government in the world is debasing their fiat currency and making it worth less, that people are saying, you know what? Gold for thousands of years has been a good place to store value. And so that is the risk off response. And I think it's a good one. And it's been a valid response. And that's the thing I think that's driving gold to all-time highs. Now, what we're seeing in Bitcoin is almost exactly the opposite, right? Bitcoin has been recently a proxy for global liquidity. Yeah. And so as you have markets, stock markets, like, in the US hitting all-time highs, and as you have governments throwing liquidity into the system, that makes its way into speculative assets and into assets like Bitcoin. And Bitcoin is traded with global liquidity and has at times been a high beta proxy for the S&P 500 or for the NASDAQ, right? And a high beta proxy simply means it trades pretty much in line with the market, but much greater amplitude. So if the market's up a little bit, Bitcoin will be up a lot. If the market's down a little bit, Bitcoin will be down a lot. And so what we're seeing is Bitcoin has kind of been the ultimate risk on asset, right? When asset prices are high, money flows into Bitcoin. Now, the one thing that I've said that I don't think is going to apply long-term is I think long-term Bitcoin is the best play possible against fiat debasement as governments all over the world engage in massive amounts of debt spending and reduce the spending power of the pound sterling, of the euro, of the yen, and unfortunately of the dollar. That is going to drive people to Bitcoin, which as of next month will become the hardest money in the world because we're hitting the halving next month. The Bitcoin stock to flow ratio is going to become even better than gold. And so my view on this, and the reason I'm so large in Bitcoin, isn't so much that I care whether we're risk on or risk off this day, this week, this month. I'm not focused on the short term. I think long term, governments are going to spend their fiat currencies into meaningless, nothingness, total loss of value. That's the direction we're heading on this. And Bitcoin, which is a great deflationary asset, where the amount of additional Bitcoin that's issued is actually cut in half every 4 years or so. That's actually where I want to have my money. So long term, my thesis on Bitcoin and gold are the same. But to answer our valid critic from Twitter from last week, what it's telling me is that you got money flowing into risk on and money flowing into risk off. The reasons are a little bit different, but I think they're going to converge over the coming years. Hopefully this will be considered a detailed, appropriate response.
If not, we'll circle back again next week, I'm sure.
Yeah,
bringing more value to you as always. Back-to-back weeks. We have one more thing for this week. Thing number 6. I'm gonna have to start changing. Don't make me change the branding again, Gary.
Yeah.
Warehouses indicating a problem with commercial real estate.
Yeah, so this was a great find by Andrew Brown, our new intern who's come to us from the University of Tennessee. He's doing a great job. And he noticed a business with 500,000 square feet. It's a distribution warehouse that was completed 6 months ago and is sitting unoccupied. So look, this part is not going to surprise anybody. Online shopping has been taking share from physical retail for 2 decades. Pandemic lockdowns caused that trend to accelerate, right? People did not want to go out and go shopping because, you know, you were going to go the wrong direction in the supermarket and get sick and die. And, you know, if you followed the arrows, you'd be safe. But I think my all-time favorite were somebody taking photos of the X's where you're supposed to stand, like at the supermarket checkout. And somebody said, you know, I've seen far too many Roadrunner cartoons to fall for this one, right? Never stand on the X, right? Whatever you do.
And from above.
Yeah, exactly right. There's an anvil coming, a giant boulder. I don't know. Just don't stand on the X.
Something.
Anyway, this caused the trend to accelerate, right? And for reasons we all understand and all participated in. And what that did was it created new demand for warehouses. You know, the other thing too, like even if we go back just 5 years, there was the sense that you could order something on Amazon, and if it took, you know, 3 to 5 days to get to you, no big deal. Who cares? How quickly do I need, you know, the replacement to a toothpaste, right? You don't wait until it's out before you order. Is it really that big a deal? No. But then Amazon started, you know, offering 2-day shipping and then 1-day shipping. And now, you know, my guess is I could order something from Amazon tonight, and there's a high chance it'll get delivered tomorrow, if not, you know, early the next day. For that to work, you need local distribution. You need more warehouses located closer to your customers. And so warehousing has seen a huge decline in employment. Part of that is due to automation, but there are macro issues as well. And national vacancy rates for industrial real estate right now, 5% in major metropolitan areas. That's as high as 8%. That's the implications for that are not good.
We have a chart in the written 5 things, Gary, where we look at just employment by industry, right? And you call out the outlier of warehousing sitting at, what is that, 1.25%, right around there, right? You have employment growth in other areas, construction, manufacturing, information down, but utilities, business services, right? Majority of those across the board up. With the government, you know, they're claiming this robust economic growth. I mean, is it these stories that you hear that Andrew brought to the table to us? Like, is that the actual sign? Is that where we should be looking for the real answers of what is actually happening and what is going on in the markets?
So, you know, Rob, I think it's a little bit of a mix. One of the things that is a danger in my business, in the stock picking business, it's very appealing to draw conclusions from anecdotes. Oh, I ran into somebody who told me they don't like to shop here because prices are up, or, you know, they don't deal with this company because there was a issue. And those anecdotes are interesting. Big picture, I like data, right? Big picture, I don't so much want to know one person's experience. I want to know what the whole economy is doing or what a whole sector is doing. We're better off looking at data. This is an anecdote. With that said, there are a lot of concerns in the banking sector about commercial real estate exposure, and I think those concerns are valid. We talked about this last week. NYCB, New York Community Bank Corp, they're having problems with their commercial real estate portfolio. Now, that's primarily multifamily residential. Obviously, offices have a problem, but you know, these portfolios are not indicative necessarily of a healthy economy. Having large parts of the commercial real estate portfolios in banks' loan portfolios failing, that's going to be a problem. And, you know, warehousing has been an area of growth. And if that reverses, it's just going to be additional problems for commercial real estate lenders.
Gary, great work as always on this week's 5 things. Got a bonus 6th thing in here today. We brought in Lax from Unicus Research as well. Thank you very much to her for spending her time with us. And thank you, Unicus Research, for sponsoring this version of the 5 things. As always, be sure to check us out online, deepknowledgeinvesting.com. Sign up for a free subscription in which you'll get notified of new content and information. We'd also love if you'd consider a premium subscription, access to all current recommendations, real-time results or thoughts that are coming from Gary. We have a lot of other exciting stuff coming up in the pipeline as well for our subscriber base. As always, thank you to everybody for watching this show and supporting us. we're trying to do everything we can to get more content in different versions, formats, platforms to reach as much of our audience as we can, as well as attract new audiences. And Gary, as always, the lifeblood of DKI, thank you for the incredible work that you do and your team to put these things together and to educate everyone, or at least bring new thoughts and opinions for their consideration.
Thanks, Rob. Much appreciated. And for everyone, thanks again for watching. We know your time is valuable and we appreciate it. This week, keep an eye on the Fed announcement. We'll be hearing from the Federal Reserve. I would be shocked if they start talking about getting rate cuts anytime soon, but who knows? Every couple of press conferences, Powell likes to surprise people, and he switched his message a couple of times in recent weeks. So, for those of you interested in financial theater, catch his press conference live. It'll be must-watch TV, very exciting.
Awesome. Thanks so much, Gary, as always, and we'll see everybody next week. Thanks, everyone.